Hi everyone, and welcome back to the Untitled Trader channel. Today, we're diving deep into a powerful Forex trading strategy that combines two classic approaches, grid trading and dollar cost averaging, also known as DCA. We'll cover everything you need to know, including 4 different entry strategies and 5 different exit strategies. So, if you're looking to maximize profits while managing risk, stick around. This one's for you. First, let's quickly define grid trading. Grid trading is a method where we place multiple buy or sell orders at various price levels, creating a grid across different price points. As the market moves up and down within the grid, these orders are triggered automatically. This can be particularly useful in a sideways market where prices fluctuate within a range. With grid trading, the idea is to make small, consistent profits on each price movement rather than waiting for a big trend move. And when combined with DCA, or dollar cost averaging, we can further reduce our risk and enhance our gains. Let's get into how DCA works and how it fits into this strategy. DCA is the strategy of regularly investing a fixed dollar amount into an asset, regardless of the asset's price. For Forex, this could mean adding positions at intervals if the currency pair goes against you, instead of placing one large order at a single price point. This approach works well with grid trading since it enables us to average down or up across our grid. This helps us balance out entry points and effectively reduce the average price level, especially if the market moves against us. When applying a dollar cost averaging approach in the Forex market, the goal is to manage risk by spreading out entry points over time rather than timing the market with a lump sum investment. Here are some effective DCA entry strategies specifically tailored for Forex. Scheduled periodic entries. This works by setting a fixed schedule, such as weekly, bi-weekly, or monthly, and allocating a predetermined amount of capital to buy the target currency pair, regardless of its price. The benefits to this approach is that it avoids emotional trading and takes advantage of market volatility by accumulating more units when prices are low and fewer when prices are high. This technique is best for traders who want to minimize the influence of timing and maintain a consistent exposure to a specific currency pair over time. Price-based intervals, price averaging. With this approach, rather than time-based intervals, you add to your position each time the currency pair moves by a set number of pips in a particular direction, e.g., every 50 or 100 pips downward if the pair is in a downtrend. This strategy allows you to enter the market more aggressively if the price moves significantly against your initial position, which can lower your average cost. This works best for traders who are looking to reduce their average entry price in a trending market. Dual DCA, combining time and price triggers. This strategy combines a time-based entry schedule with a price-based entry condition. For example, you might enter at a scheduled time, but only if the currency pair has moved 50 pips down from the last entry point. By requiring both conditions, you can reduce the number of entries and avoid overexposure in a rapidly falling or rising market. It adds an extra layer of control over your DCA entries. This approach is best for traders seeking a balanced approach that moderates the frequency of entries in highly volatile markets. Trend-based entry points. DCA here is based on technical indicators or trend analysis. For example, you might enter positions periodically only when a simple moving average, SMA, suggests a bullish trend or after certain reversal patterns respecting the SMA. Aligning your DCA entries with technical indicators may allow you to capture moves aligned with the overall market trend, potentially enhancing profitability. This approach is suitable for traders who prefer to align DCA with technical analysis and avoid purely passive entries. Some practical tips for DCA entries in Forex are: 1. Use smaller position sizes. Forex markets are highly leveraged, so smaller positions reduce the risk of outsized losses. 2. Set a clear maximum exposure limit. Define a cap on the total amount you're willing to invest to prevent overcommitting in a downtrend. 3. Adapt DCA to volatility. Currency pairs vary in volatility. Adapt your entry intervals, time-based or price-based, based on the pair's historical volatility. Trading indices and/or crypto is generally not a good approach when using DCA. Each DCA approach in Forex has its own risk-return profile, and the ideal strategy will depend on your goals, risk tolerance, and market outlook. Now let's look at some exit strategies you can use. 1. The profit target exit. Take profit levels. This is when you set specific profit targets for your DCA trades. Once the average price of your DCA position reaches a predefined profit level, you close part or all of your position. You can exit when the trade reaches a certain percentage gain, like 5% or 10%, or you can set a target in pips, based on the pair's average daily range. This approach is best for traders focused on consistent, modest returns and who prefer quantifiable profit goals. 2. The break-even exit. This is when the average price of your DCA position recovers to the break-even price. Here you will close part or all of the position to avoid potential losses. This is best for risk-averse traders who want to exit as soon as losses are neutralized. 3. The staggered exit. This allows you to capture profits on individual positions without waiting for the price to reach a single profit target price for all of your opened positions. This approach is especially useful in trending markets as it locks in gains while reducing your exposure. The offsetting exit. One of the key benefits of the grid trading DCA strategy is the ability to offset losses with your wins. This works similar to the staggered approach, but instead of keeping your profits, you use them to offset some of your losses. If you have multiple entries on a specific pair, then once an entry moves into profit, you can close that entry to offset another entry that is in a current loss, covering either the full loss or a partial loss. The same applies if you have multiple entries with different currency pairs. If one currency pair is in profit, you can close that position to close another currency pair position that's in a loss. 5. Risk-based exit. Maximum drawdown. This is when you set a maximum drawdown limit for your DCA trades. If the cumulative losses reach this level, you exit all positions at a loss. You can either exit if cumulative losses exceed a set dollar amount, for example $500, or you can exit if drawdown reaches a specific percentage of your account balance, for example 5%. This approach is best for traders who want strict loss controls and be protected against prolonged downturns. Now let's look at setting realistic profit targets with an example of a $5,000 account balance. With a $5,000 account, it's important to set realistic profit targets. The grid trading DCA strategy is designed to capture small, consistent gains rather than huge one-off profits. For a $5,000 account, a reasonable profit target might be around 2 to 5% per month, or approximately $100 to $250. This may seem modest, but remember, consistent returns add up over time and reduce the risk of large losses. If you're looking for more ambitious returns, consider optimizing your lot sizes slightly, but always keep a close eye on margin usage and risk. The goal here is steady growth. As you become more experienced and gain confidence in your strategy, you can gradually increase your target or even add another currency pair to diversify. Ultimately, the key to successful grid trading with DCA is patience. These steady gains build your account balance over time while keeping your risk in check. This way, your grid trading account has room to grow, even with conservative targets. Now let's have a look why traders still lose, even when using a DCA approach in their trading. The main reasons why traders fail, even when using the DCA approach, is because they either oversize their positions or they close their trades too early. Once a trade goes repeatedly against them, their brain turns into a safe mode, trying to protect them when they are in drawdown, however leaving them in realized losses. A way around this emotional fear is to first divide your account balance into at least 4 separate accounts. If you have, for example, $20,000 to play around with, divide this into 4 $5,000 accounts. Then, by using a DCA grid approach on all 4 accounts, once you manage to double an account, from $5,000 to $10,000, you withdraw your profit into a separate main trading account or into your bank account. Now that you have locked in profit, you are now emotionally prepared to actually lose one of your other accounts, allowing you to trade with a clear mind. As irrational as it may sound, it is okay to blow an account when using DCA, so long as you have multiple accounts and you are withdrawing your profits into a separate main account. By the way, I do understand that most traders do not have $20,000 to start their trading career. In this case, you can use prop firms to slowly start your journey. You can buy a $200,000 challenge for approximately $1,000. However, like I mentioned before, you are better off buying 4 separate challenges of $50,000 for about $350 each. The logic behind this is that you now have 4 accounts instead of 1, each with about a 10% maximum drawdown, which is $5,000. A small tip here is that you will want to choose swing trading accounts, which will allow you to keep your trades over the weekend when the markets are closed. When using a DCA approach, you will find yourself in situations where you will have to hold on to trades longer than you expected. If you're just getting started in trading, I encourage you to test this strategy on a demo account first. Get a feel for how small profits add up over time, and pay attention to how your grid responds in different market conditions. Small lot size entry positions combined with a diversification of trading multiple currency pairs in the same account, and then combining that with splitting your trading capital into at least 4 separate accounts and withdrawing your profits increases your probability even more of being profitable in the long run. So, to sum it all up, grid trading with DCA offers a way to capture small, consistent profits and manage losses by offsetting them with gains. Find which currency pairs work best for you, what time frames work best for you, how you optimize your entry intervals, and which exit strategy best fits your character. With these tailored choices, you will be able to implement a more refined DCA strategy in the Forex market, balancing consistent exposure with risk management and potentially improving your overall return. The problem, of course, now is whether you will be disciplined enough to stick to your trading plan, and will you have the patience to grow your account gradually. Over 90% of traders fail because they start trading, expecting for results and big profits immediately. Do not let that be you, and if it has been you so far in your trading journey, you now have some valuable information to change your course. At this point, I want to congratulate you for sticking around. It means that you truly want to learn, and of course, become profitable in this game called Forex trading. If you have found any value in this video, all I ask for in return is for you taking a few seconds of your time to like this video and subscribe to my channel. It literally takes only 2 clicks, but it means so much to me. Thank you for watching, and trade wisely, with discipline and patience.